So, so that's really the purpose of why we're doing this charting session is to go through the charts and to listen to the weight of the evidence. And when we say evidence, evidence means as opposed to opinion. So we're listening to evidence, and based on the system, the discipline that we entail, the evidence that we are referring to is the evidence of price action. And so we're here essentially to listen to what price is actually telling us. Because after all, as traders, our number one job is to really differentiate signal from noise, right? So, and these are things that you really have to be mindful and mentally aware as to how your environment can really influence the way you act. And I think on a daily basis, it's very important to always have that mindset that you're always trying to fend off noise and just trying to take in signal, the type of signal that will make us money. Let's dive into the charts. So I'm going to share first. So I am going to share first. Let's start with the PSEi. Matt, kita nyo ba? PSEi? Ayan.
Yep. We can now see your screen, Javi.
So the PSEi is pretty simple. If you approach it from a classical point of view, the most important signal that we had this week was pretty much the breakdown. And when I say a breakdown from this area pattern support. Now, for newbies out there, old members know that I like to draw my support and resistance levels with crayons and not pencils. Why? Because that gives us a margin of safety for at least estimating breakdowns and breakouts. So you'll see here a shaded area, and you'll see here a clear breakdown of support. And in Open Journal, we've always thought that breakdowns or even breakouts happen on the third test of the pivot. So when we say third test, you have your first test of that support, second test of that support, and then you have a third test over here, which we thought prices would break down. But then you saw a retest and then prices break down on the fourth. So pretty much 60-70% of the time, 60 to 70% of the time, prices break down on the third test of support. So we saw another retest of that here, and prices eventually broke down. So just to keep it simple, guys, a breakdown is a beginning of a downtrend. And you can approach it as a breakdown of this area pattern support, which a lot of people have identified as a potential or a head and shoulders. So going back, this is a breakdown from a head and shoulders. You see here the left shoulder, the head, and the right shoulder. And technical analysis book, any basic technical analysis book will tell you that if you take the size of that pattern, you can estimate at least where the potential breakdown target will be. And if you see here the size of the head and then you put it below here, you'll see that the minimum breakdown target is actually here at around 6,573. So that's 6,573. So just to keep that in the proper context, what technical analysis says, and whether this is a local book or even the CMT Bible's technical analysis, Edwards and McGee, John Murphy, Martin Pring, they say that if you estimate minimum breakdown targets are essentially a 70 to 80% success probability. What that means is that, number one, can prices break down here and then rally back up, create a false breakdown? Of course, that's possible. But obviously, our job as traders is there's no guarantee in the market. There's no certainty, only opportunity. And our job is to simply place all our trades on the side of major probabilities. Because if we do that, let our winners run and cut small, then that's how you make money. So going back, one way to look at it is a breakdown from a head and shoulders pattern. Minimum target is 6,582. Another way to look at it is that it broke down from this rising wedge over here. See this rising wedge. And if you take the size of that wedge, and then you put it below here, you'll also see a breakdown to around the 7,000 area. So at least we're seeing prices go to the 7,000 or to the 6,586 area at the minimum. So that's where we are right now. More importantly, most of the advanced traders, if you've been trading for a while, you guys know that after a breakdown, you have a retest of that breakdown point. So we'll probably rally. So we're in that. So that's where we are exactly right now. Prices are rallying here to this support, which is now resistance at around 7,576. So we'll most likely rally to that area. We'll maybe have a small bullish window before a high probability, 60, 70, 80% of prices rolling over and following through lower. So that's essentially where we are now. I've had some notable people within my ecosystem. Of course, we'll keep those anonymous, but notable people within my ecosystem say na pwede na pumasok sa market, or that you can already now deploy for the long term, or that prices are already too cheap, oversold, and that there's really no way to go but up from here. I would have to disagree with that. Not because of my own opinion, but because of the weight of the evidence. So what we just did the past 5 minutes was take a look at the index from a top-down point of view. If I just take you through some of the underlying index issues from a bottom-up point of view, you'll see that there are a lot of index issues that have yet to meet their minimum breakdown targets, again, from an evidence point of view. So let's start with yung mga malalaking weighting. So this is GT Capital. So I'm just going to go through these guys very quickly, so at least we can move on to the charts that actually matter. So GT Capital, just looking at it, you have a head and shoulders here, left head, right shoulder. And then simply put, if you just take the minimum breakdown target of that head and shoulders, you will see that wala ka pa sa minimum breakdown target. So you still need at least a drop until at least 574 to at least satisfy that, at least from a 60, 70, 80% point of view, which is the batting average of technical analysis. So again, you'll see loads of examples like this, not just GT Cap, you have PLDT. PLDT from a long-term target, you'll see a double top over here. And then you take the size of this double top, put it below, and then you'll see a potential breakdown target of around 700-ish. So we're still far away from that. So those of you who are thinking that this may be a double bottom, no, that's probably just an area pattern before it breaks down. It's not just that. You also have, let's say, stocks like BMC. I know some of you guys are looking at the issues that were recently affected by the reneging of the government on the recent contracts. So again, this is a double top. See here, first top, second top, breakdown of the support. If you just take a look at that pattern, put it below, you'll see that we still have yet to satisfy the minimum breakdown target of that, which is 4.22. It's not just that. You also have a lot of other issues. Take, for example, Security Bank. The banks are pretty much in a bad position. Security Bank, very clear, 5 waves down. You have a rising wedge over here. And then we still have yet to meet the minimum breakdown target of Security Bank, right? So which still has some ways to go. Minimum breakdown targets. You have charts like Metrobank, which are long-term charts, which are at the minimum very interesting to say at least. So this is your 8-year chart. This is your 8-year support, and prices look like we could be breaking down from that 8-year support with a long-term downside target that is just kung merong too good to be true, ito too bad to be true, diba? But that's a discipline. We follow price. And every time I've had a price that was too good to be true or too bad to be true in the past, tumatama siya eh. And that's just the experience of following price. So you have Metrobank. Metrobank pretty much looks like BPI. If I'm going to go through, let's say, some of the other big caps, you have recent death crosses on Ayala Land, Ayala Corp, BPI. Pretty much 70% of the index issues already in death cross, which is, as you know, a lagging confirmatory signal of a downtrend or a bear market. Not just that, you have issues that have yet to break down. You have, take for example, the Aboitiz issues, which on a long-term basis are testing that long-term support. So that area of support over here, that's AEV. That looks like Aboitiz Power as well. Aboitiz Power looks like it's testing that long-term support as well over here. Not just that, you also have Meralco, which also looks like it's testing that long-term support over here. So definitely, whether you look at it from a top-down or a bottom-up point of view, not from an opinion point of view, but from an evidence point of view, and if you take the starting point of humility and just listen to what price is actually telling you, then you will at least be erring on the side of caution, at least for index or index-related issues. I mean, it's not just the case. Not only, I also want to highlight that if this is your A, B, or this is your 1, 2, we're now experiencing either a 3 or a C wave down, which is pretty much the strongest part of the downtrend. It's the one that moves the fastest, and the logic is very simple. In an A wave, sentiment is still bullish because kakagaling mo lang bull market. B wave is people thinking that the bull market is back. C wave is essentially where sentiment shifts completely from positive to negative, meaning from lumalaban pa, denial pa, pwede ba tong bull market, or from hope to shit, na bear market na to. So because of that change in sentiment,
Undue hair damage, we expose.
right? So because of that change in sentiment, then prices move a lot faster because all of the people are pretty much on the negative sentiment side, and you don't have a lot of positive people trying to buy the dips. So I would imagine that after this retest over here, and after prices roll over, and again, that's 60, 70% probability, 80%, then you're going to see, I would say that the best is yet to come, all right? So, so at least that's what we have for the index. Remember, as prices go down, and maybe some of you may be thinking about bottom picking, bottom fishing, the earliest sign of a reversal is always a bullish divergence. And after a bullish divergence, you have a reversal pattern. Across all index issues, maybe with the exception for AGI, you still don't have any evidence of any bullish divergence, at least a meaningful one, a class A one, or even a reversal pattern. So until we get those reversal patterns, whether it is a double bottom or a reverse head and shoulders or your square roots, your V's or your W's, this is pretty much a market that you want to be staying away from, at least from a strategic point of view. So with that said, the opportunity still, or the strategy remains the same. And when I say strategy, this is a strategy that we've had since second half last year, since June, May, July last year, when we were publicly and consistently bearish on the index. And the strategy is simply two things. Number one, bottom-up tactical opportunities for local. That's the first strategy. And second strategy, obviously strategy for making money, is to strategically allocate capital to other financial markets or other markets, stock markets that are uptrending or that show upside opportunity. So let's touch quickly on some other stuff. So I just took you through the index. So I'm going to show you something as well. Matt, can you see this? So I'm going to, right. So if you can see my screen, just to take you, zoom out to the much larger picture. Zoom out, not only are we looking at the 6-5 area, at least with the system that we've taught so far. So we've taught you that using a DCS, so you can actually draw a channel over here, that's our DCS. And then we have a potential E1 over here. Potential E1 over here at the close to the 6,000 level. The 6,000 level is not only the E1 of the channel support, meaning the support of the DCS or the channel, but it's also an overlap or a confluence with two other major supports. What are those? One is it's the 382 fib support. And the 382 fib support is important. Why? Because the 382 fib support is essentially the historical relationship, at least from a probabilistic point of view. It's the historical relationship between a wave 3 and an unfolding wave 4. So obviously, I'm not saying that that's where it always goes. What I'm simply saying is that 50-60% of the time, majority of the time, you're going to see wave 4s hit support at the 382 fib relative to wave 3. So that's the first overlap. The second overlap is that typically when you have a correction, or let's say a move like this, prices will typically find support at the, I need to listen to me very carefully in this, it will find support at the wave 4 of the lower degree. I'll repeat, it will find support at the fourth wave of the degree lower. What do I mean degree lower? If you look at the smaller degree, remember this is the degree that we're tracking, the red 3, the red 4. If you look at the smaller degree that we're tracking, which is this blue 5, blue 4, circle blue 3, you'll see that the wave 4 of smaller degree pretty much is around this area over here, this 5984 as well. So you have three overlaps there. You have the DCS support, the 382, and also the the 382 fib support, and the wave 4 of the smaller degree. And that is essentially the secret recipe behind the I Love You 6,000 call that we pretty much tried to use as a handle to help warn people of a pending decline in the Philippine stock market. I think we started with that sometime second quarter 2019. So that wasn't just something that we released because it sounded cute. That was evidence-based and that was science-based, and now you guys know what the scientific basis was, at least from a technical point of view behind that. So that's at least where we are mentally with respect to the index. Now, it's also been said, so this is a chart taken from the recent COL market briefing. So this is something I'd like to touch as well for the charting session today. Why? Because there has been a prevailing belief, at least over the past few weeks and months, that the Philippine market should follow through higher eventually because it's a laggard to the whole emerging markets, which are in an uptrend, in an uptrending market. So that has been pretty much the argument for the past few months. Aakit ang Philippines, why? Kasi buong emerging markets umakit eh. So just to take you through some charts. So just very quickly, So I'm going to take you quickly through some charts if I am going to, okay. So let's minimize this. Right. So this is the emerging markets index. So I'm going to, so if you look at the emerging markets index, you'll see that just not even looking at the wave counts, just looking at the DCS, you'll see that the DCS fits perfectly with a 5-wave move down. And not only that, we have a potential A, B, C over here, which rallies all the way to the 618 fib. So we have here a rally to a little above the 382, pulls back, and then rallies all the way to the 618 fib, which is textbook for any corrective pattern. And any corrective pattern is bounded by a DCS or a parallel channel over here. So my concern, or at least, it's not a concern, but at least one of the things I'll be watching out moving forward is if this is your A, this is your B, and then you're now actually entering a C wave lower. Now, I'm not even gonna mention what's driving it, but just looking at the evidence of price, price, at least within the realm of what's been possible and what's probable, it's very much possible to see at least prices move lower in a C wave fashion for emerging markets. There's some other emerging markets that are worth noting. So I'll show you the ones that are most correlated to the Philippines. So you have Southeast Asia. If you just take a look at Indonesia, Indonesia very clearly in a C wave already. You'll see it's a C wave because of the just the degree of the destruction. You'll see a very much accelerated move lower. You have here a runaway gap, possibly even a breakaway gap, right? So that's roughly at 1.5 18-month base before price is actually breaking down. So you have here an A, you have a B, and then you have a potential C wave lower. If we just take a look at where the potential downside of that can be, you'll see that there's still a lot more space for prices to move lower. So it's not just that. If you take a look at some of the other emerging markets, you'll see Indonesia. Indonesia still on the sideways, technically speaking, but that's something to watch as well to see if it breaks down this support area over here. But emerging markets in general, especially if you just look at China, look at Hong Kong, HSI, SH Comp, China, you look at THD, Thailand, Indonesia, just listening to the weight of the evidence, then the evidence is actually pointing to prices moving lower as the main probability. Now, what could be causing not just the Philippines, but emerging markets in general to be moving lower? Now, some of you obviously will have a word that comes to mind, and obviously that word is the coronavirus. Some of you may say, or maybe thinking that it was the Duterte administration that caused the markets to go lower. Again, those are opinions, right? But what I'd like to point out from an evidence point of view is that if I show you what's been causing, let's share. If I show you what's been causing not just the Philippines, but emerging markets to go lower, you'll see that it's actually been foreign selling. Matt, can you see the foreign selling for emerging markets?
Yep.
All right. So from an evidence point of view, you'll see that even from 2018, it's pretty much been foreign selling. And this is doubly important for the Philippines because for some of you who don't know, the average foreign selling component in Asia or even Southeast Asia, the average hot money component or net foreign buying selling component on an average on a daily basis is somewhere between 20 to 25 to as much as 30%. That's the range, right? But the only exception to that in Asia is actually the Philippines, which is at 50%. So it just goes to show that the Philippines is doubly at the mercy of hot money relative to other Asian countries. And you'll see here the evidence of foreign outflow coming outside of the Philippines. But here's what's interesting. Everybody is attributing the foreign outflow to coronavirus. But when did the coronavirus start? Coronavirus started a month at best, which is this area over here, right? But if you'll see, the foreign selling has actually been persistent and pervasive over the past 18 months, not just in the Philippines, but in other emerging markets as well. If I'm going to show you who the hidden driver is, I would even argue more than the coronavirus. It's actually this chart over here. So this is maybe the last chart that I show you before we actually go to your chart quests and Bitcoin. So this is the DXY chart. So maybe some of you may be looking at this chart for the very first time. So the DXY chart is simply the main dollar index. So it's simply the main dollar basket. If investors around the world want to see what the world's reserve currency is doing, is it appreciating, is it depreciating, then the ticker symbol for that is the DXY or the DXY. For trading view, for stock charts, it's the dollar US. So it's a DXY. And if you simply look at the trend of the DXY since May, or for the past 18 months, when foreign money started to leave not just the Philippines or emerging markets, you'll see the DXY actually, it's been appreciating, right? And maybe some of you are thinking, what does an appreciating dollar have to do with money going out of emerging markets? The answer is simple. If you're a foreign fund manager and you're investing in the Philippines, China, emerging markets in general, you simply convert your dollars to the local currency. And let's say, for example, you buy SM, you buy Ayala. Even if you're up 30% on Ayala land, and that's a hypothetical, obviously, even if you're up 30% on an Ayala land, if you're a fund manager who needs to convert it back to dollars eventually when you repatriate the money back to the fund, if, let's say, the dollar appreciates by 20%, then let's say you're up 30% Ayala land, you sell the position, and then you have to move the dollars back to, let's say, where you are. You have to buy dollars back 20% higher. It means that, yeah, you made 30% in Ayala land, but natalo ka ng 20% sa Forex, so panalo mo lang is 10%. And that's pretty much the number one driver for hot money flow into and out of emerging markets. If you look at the biggest driver of that equation, it's just simply looking at the dollar and how the dollar influences what is called the carrying cost of having investments in emerging markets, or what they call the carry trade. So that's essentially what you have. And if you look closely here for the dollar, at least in the short term, you'll see the dollar break out from what looks like a area pattern over here. So it broke out from this area pattern over here. After a breakout, you have a retest, then you have a follow through higher. And then you still have ways to go for that dollar to move higher at 99 from where it is now at 98. So to me, that tells me that the underlying current, meaning an appreciating dollar, which makes it more expensive for foreign money to stay in emerging markets, if that's going to go higher, then at least over the short term, few weeks, few months, that is going to encourage more money outflow from emerging markets. You take that coupled with the coronavirus scare, then obviously that looks kind of like a good fundamental explanation for a C wave as to what we are which is our main focus from a technical evidence-based side. So that's essentially what's happening, not just to the Philippines, but to emerging markets as well. You have a depreciating dollar, which is causing money to flow out of emerging markets, Philippines included. And you have a coronavirus, which is causing more of an acceleration or an added fuel to that fire.